Hello and welcome back to the ROI podcast, the Return on Investment podcast, where we're obsessed with the art and science of return on investment. And today it's my great pleasure to welcome to the channel a guy that I've been following for a few years now and whose investment thesis and philosophies have really started to occupy a large space in my brain. So very privileged to have James Davolos from Horizon Kinetics on the channel today, guys. If you get a little bit of value out of this, please do like and subscribe to the channel. And a disclaimer, of course, nothing that we say is advice. It's just two guys having a chat about things that are happening in the world. James, welcome to the channel. I would love it if you could give us perhaps a 2-minute synopsis on you yourself and how you came to be at the infamous firm Horizon Kinetics.
Well, first, thanks so much for having me. Really appreciate you taking the time. My background is, I'd say, a little bit different from most people that are in the financial services industry, where, I went to a non-target undergrad school, came up to New York thinking like pre-global financial crisis. So this was 2005, and reading about all of these hedge funds and people making all this money and all these exciting things happening. And luckily, I had a roommate in college who had a family apartment in New York. So I came up here thinking I could just get a job and that would be that. And clearly, it's much more difficult than that. But I ended up getting really fortunate where after I kind of interviewed at a bunch of places that were very salesy or trading or short-term oriented, I ended up starting at Horizon Kinetics on the trading desk. This was December of 2005. And the trading desk isn't one of these trading desks that you would see on, a movie or a Wall Street, series. It was basically order entry. So the PMs would send out literally a yellow legal pad of orders, and then I would call those across brokerages, across different financial firms to execute the orders, book the orders, and that was my job. So one of the partners of the firm, Peter Doyle, took notice that I was far more interested than just kind of going in and punching out. And so he let me start reading the research, attending some of the research meetings, and then ultimately pitch some ideas and transition over onto the research and investment team. And, by virtue, I think, of the global financial crisis in 2008, 2009, which kind of destabilized things, but also provided a lot of opportunity for a younger person like myself. But then also the lack of hierarchy at the firm, which we could talk about later, enabled me to take on a lot of responsibility really quickly and then kind of really learn and do things on the fly under the stewardship of Murray, Peter, and Steve, to where ultimately I got my MBA at night in New York, and then started taking over portfolio management responsibilities. And, as I look at the calendar today, almost 19 years now I've been at the firm. So boom, big bust, and then kind of rebuilding the firm and kind of reprioritizing what we do best. And, I truly do believe the best is yet to come for the firm, and, happy to talk about some of the initiatives that we're working on today. But, definitely a non-traditional background of, didn't do the internship, didn't do the bulge bracket bank, didn't do the banking. So everyone's got their story. It takes a little bit of luck and certainly a lot of hard work.
Yeah, absolutely. Well, I think it's a great vote of confidence if you're put in charge of a portfolio at Horizon with some of the legendary names that you mentioned. I've got to ask, what's it like working with Murray? I mean, I read everything I can get my hands on that the guy's written, and I'm just fascinated by the way his brain seems to work. He's got this ability to think around corners and truly be a unique thinker. What's it like looking up to a guy like that, I presume, and working in the same firm as him?
I'd say early, when I say early days, I mean the first 10 years of my career working with him. It was actually discouraging and humbling because I quickly realized that you need to be born with, obviously you can cultivate and build on the skills, but he has something innate that I don't think you can teach or train. Um, People have said he has a photographic memory, but also his upbringing and training, if you will, and education. Most people, once you get through your undergraduate and high school and studies, they take a very specific path towards finance, economics, mathematic driven, and they kind of follow that textbook way to invest. Murray takes a much broader approach where he actually has multiple degrees in multiple social sciences. And so I would say that you could argue that he is an expert, maybe even a graduate level expert in a variety of topics ranging from philosophy to economics, and even has certainly a collegiate level understanding of things like mathematics, chemistry, and physics. And so having that broad of a background, plus just an absolutely absurd understanding of history, he approaches things wildly different from almost anyone else you're going to see on Wall Street, where, today we had the Jackson Hole Symposium, last week we had, Fed minutes, and you have everybody chasing their tail to try to distill and understand what to do. And Murray takes a step back. And I think, to your point, he's playing chess. He's looking 8 moves ahead, which is how you win at chess. You don't look 1 or 2 moves ahead. And I think that it's humbling and discouraging until you realize that you utilize that as a benefit. But, to be honest, you're never going to be that. And I think that, it'd be like Warren Buffett. You have to recognize you're never going to be Warren Buffett, but you can try to be close.
Yeah, it sounds like a strange comparison, but as I'm reading some of his work, I think to myself, like it's like rolling with a high level jujitsu black belt that you're rolling and you're just like, oh my God, like this guy just knows he's everywhere at the same time and knows all the different permutations of outcomes. It's truly impressive. I'd like to lead in with a quote of Murray's from one of the commentaries. He says that if a stock goes up 40% in 2 years, that's most probably a valuation change, not compounding. We have securities that are compounding. I'd like you to perhaps, with that in mind, explain some of those differences between how you guys at Horizon think about investments versus a typical, let's call it, a valuation shop.
Yeah, I think that most people, and it really goes back to incentives. And I think one of the most famous quotes in investing is, you show me the incentive, I'll show you the outcome. But 99% of investors are compensated on a 12-month calendar year end. Now, obviously, there's exceptions when you have privates and things with different marks and carry, but if you are aiming for a bonus that is oriented around December 31st, you are going to optimize your portfolio for that date. And as a function of that, you're always looking for a catalyst. And so, most of these shorter term funds are looking through every earnings report, trying to understand where maybe the consensus is too high or too low, and then kind of optimize their relative positioning around that. And so I think what that quote means is, okay, we're going through just a wild era of where there's just such a propensity of non-fundamental information impacting stocks. So a headline on AI, a headline on interest rates, a headline on jobs, and it's fluctuating the valuations of trillion-dollar companies by hundreds of billions of dollars a day. I think we can all say fundamentally that that is not consistent. So just because a stock has gone up 40% in a year or two by virtue of a perception that there's an AI vertical, I think is not necessarily indicative of fundamentals if you don't see the cash flows. And part of what that commentary was referencing is that we've seen a lot of capital expenditure around AI and very ambiguous economic returns. And so, I think that there's kind of 2 barbells. On the left barbell, you have the fiber optic experience of the 1990s, where all the telcos laid billions of dollars of fiber that's still not fully utilized. On the right barbell is you have, the Microsofts and the software giants of today, where they have applications that are built on that base layer. Or it could be somewhere in the middle, where it's kind of just a status quo continuation of these companies' admittedly high ROE. What we look at is, okay, are companies establishing the basis to have long-term compounding businesses on a strong asset base? And this could be recognized. It's very seldom recognized linearly. Generally, it's recognized in different types of episodic periods, but you always need to kind of reconcile the market recognition of the fundamentals versus the perception of a catalyst. And I think that there's a big discrepancy in the market today where we would argue a lot of the market is pricing in borderline euphoria around the AI and the AI investment cycle. Then you have a lot of old world economy businesses in materials, industrials, energy, even some financials that are pricing in different variations of a recession. And so clearly both can exist. And I think that looking at the fundamentals, we're always trying to look at companies that are setting up the business to compound, not just the stock price to compound, because eventually it will reconcile.
Indeed. And part of that business model that you focus on a lot is this idea of a hard asset but capital light business model. One thing that's really on my mind and has been for the last, let's say, 4 years is the idea of inflation. And people thought I was a little bit crazy in 2020, 2021 talking about inflation. And it's starting to become more of a mainstream concern, or at least in the awareness of the mainstream. Talk me through the threat that is inflation. Why is it such a big deal to my purchasing power as a young man, entrepreneur trying to build my wealth, or as an older person simply looking to preserve my purchasing power into retirement? Why is inflation such a problem? And why have you chosen in the ETF that you manage, INFL, to focus almost exclusively on these hard asset capital light type businesses?
So just to back up, I think that there's a lot of things that need to be clarified around inflation. And I think that particularly with a let's call it highly charged election cycle in the United States right now, there's a lot of misinformation or misunderstandings about inflation. But inflation is simply just rising aggregate price levels, and it's most commonly reported based off of a 12-month annualized change. So rising prices and then rising prices at a different rate of change are where a lot of the nuance gets lost. So, the average person in the United States with a median household income might say, hey, I just read the paper this morning and it said inflation's coming down, but I can still barely afford to fill up my car and groceries every month. And that's because, sure, inflation was rising at 8, 9, 10%. And we've had disinflation to where it's still rising. And it's actually been stuck at about 3% for over a year now, in spite of interest rates coming from effectively 0 to 5.5. So what that means is not only have prices risen off a base level of 10, 15%, but they continue to compound at 3% off that level. So short of deflation, there's really not relief for the customers, or at least not visible relief for the customers and consumers. So when you think about everything that goes into your daily basket, and here's another area that I think is a lot of confusion is, and not to pick on the government, I think the government does a decent job, but CPI is a very imperfect basket. They are trying to standardize what the average person's daily expenses look like to estimate inflation. But that can be extremely different for you, for me, for an 80-year-old, for a 20-year-old, for an urban person versus somebody in a rural setting, somebody with a health issue, anyway. A lot of people also say, look, my experience is not only rising 3%, my experience is rising 10%. And I'll give you a great example. I know Australia is actually worse than the US in terms of housing affordability, but since the beginning of the pandemic, the Case-Shiller housing price index is up about 50%, 52%, somewhere in that range. The Bureau of Labor Statistics, the BLS, 60% of CPI is shelter. Shelter is a big part of everybody's living expense. So they use two measures. One is called rent, which is just a survey. The other is called owner's equivalent rent, where they would call you up, Ben, and they'd say, hey, Ben, what do you think you could rent your house for? So scientific, no. Directionally correct, maybe. BLS says that housing and shelter prices have gone up 24%, when housing prices have gone up 52%. So sure, there's a difference. If you've been in your house this whole time, your actual monthly expense hasn't gone up, but tell that to the 30-year-old family of 4 who's trying to buy a house for the first time with a 7% mortgage, and they're bidding up into a market that's 50% higher. So with that being said, just think about the erosion in your purchasing power. Again, use that 30-year-old family example. You have to bid up into a 50% higher market. You're also probably going to get about a 7% mortgage instead of a 2 or a 3% mortgage. You're also putting 20 to 25% down in US markets on a inflated 50% housing price. Then you've got the groceries, you've got the healthcare, you have the fuel, you have the insurance. And so even if the US claims that average private payroll wages have gone up with inflation basically over the past 4 years or so, you're at best you're at best flat if you are kind of consistent with that wage number. And so it's really a pernicious effect because it prevents you from saving and it also erodes your spending power in the future. So that's it from a individual standpoint, but then from a corporate standpoint, if you look at the return profile of the S&P 500, and this is true for most multinationals as well, going back to 2010, so the recovery out of the global financial crisis, yes, there was strong sales growth, but the majority of the return was driven by margin improvement and then multiple expansion. So by virtue of margins, these companies were able to push on prices and cut costs. And this isn't predatory. It's, they have good business models. They've realized efficiencies. But you've seen profit margins expand in the United States about 500 basis points in the last, call it 12 years. So from around 10% or so to 15% operating margins. That's a massive difference. And a lot of that is that these companies, through those sluggish growth 2010 to 2019 era, they were able to procure cheap raw materials, cheap labor, invest very inexpensively, by the way, using very inexpensive financing. And so a huge underappreciated part of the market return during that period was margin expansion, which then resulted in higher multiples. If you have inflation, so your supply chain, your raw materials, your labor, your distribution, your marketing, your rent, your insurance, and your funding costs have all gone up, let's just say it's going to be extremely difficult to even hold on to your margins, let alone expand them further. And so we think that there's really been a massive paradigm shift from an era that was almost Goldilocks for equity returns, for all risk asset returns, into an era that's still going to be accommodative for risk assets, but I think you're just going to have to be a lot more discerning in which risk assets. And so I went through a lot there. I don't know if you have any questions before we go into exactly how we kind of express this view.
And no, I might just make a few little points still in the macro before it leads in perfectly as a segue to the business models that you're interested in. Just to really hammer home to people, an inflation rate of 8.4% annually over 10 years erodes your purchasing power by more than 60%. I mean, that's a decent amount. In addition to which, you mentioned the expansion of corporate profit margins in the US with the associated multiple expansions. In your commentaries, you guys have talked about some, 4 key factors that allowed that to happen. That I'm not going to say it's impossible that they happen again, but it's pretty darn unlikely. So your raw material geo arbitrage from the breakup of the Soviet Union, labor arbitrage, outsourcing to China. And is there anything else you'd like to talk about in terms of the narrative or the evidence that leads us towards this narrative that we are almost certainly going to have higher inflation and more volatile inflation for longer based off those kind of factors that would lead to margin erosion now, as they're not likely to repeat themselves?
I think that, going back to kind of Murray's background, we can also kind of bring up like a sociological factor, which is that humans, even economists and all of these people that are so wedded to numbers, we still have this anchoring bias. And everybody is anchored to saying, well, over the last 10, 15, 20 years, inflation bounced around 2%, and that's just how the world works. But if you look at what contributed to that, whether it's the technology, the globalization, the resource mobilization, you could argue that every one of those trends is ending, if not reversing. And those were massive contributors to these profit margins. And when that stalls, at best, I think your profit margins stall. But if it reverses, you're seeing onshoring, you're seeing depletion of the lowest cost reserves, you're seeing deglobalization and protectionism around trade. Technology's kind of reached a plateau unless you really do believe that AI is going to reach AGI and have these massive productivity gains. And so again, I would argue, barring a productivity miracle, which some people certainly seem to think is going to happen vis-a-vis AI, these profit margins are going to have to mean revert. And I don't think that that's properly appreciated by the marketplace. And, that's one of the other very pernicious aspects of inflation. And people just, I'm writing a new commentary now that's, a little bit late, but it'll be out soon, that talks about, people just look in the rearview mirror and say, well, it was around 2% for 15 years. We had this aberration during COVID. It's going to go back to 2. And it's like, well, let's back up and unpack why and how it was 2 before just saying, well, that's the way it was. That's the way it's going to be going forward.
Yeah, indeed. Very wise. And if you outline the US fiscal situation, it seems almost that an elevated inflation would reduce the net present value of the current liabilities. And so, there are some people that might argue that it's a feature of current monetary policy as opposed to a bug. Let's say we do get a productivity boom. How much is that really going to offset the fiscal spending in the United States and what appears to be the associated monetary policy from the Fed?
That's another really good point. When you think through first derivative, second derivative, third derivative. So let's assume that AI, take Walmart's earnings call. They did recognize a lot of efficiencies around optimizing their stock keeping units and then targeting certain products to certain customers. And okay, everybody is throwing a parade saying that you've got a use case. But again, okay, what does that do? Does it displace labor? And labor is one of the biggest contributors to GDP. It's basically workforce times productivity. So barring something that enhances productivity of labor versus replacing labor, yes, for the productivity side will go up if you replace labor. But then that portion of having a lower workforce, you're not really getting the growth that you need. But all that notwithstanding, I think in an environment where technology marginalizes labor, now there's a greater and greater onus on the government to just spend more and more and more and have greater entitlements. And you can see some of the rhetoric that's going on through this presidential election. I don't think any of it would actually be instituted when you're talking about taxes on unrealized gains. Like, I don't even know how you could implement that. You're talking about skyrocketing capital gains tax. You're talking about giving people money to buy houses. And, both parties, I think, have very inflationary policies. On the other side, you've got tariffs, you've got protectionism, anyway, it's, people get too tied up in the election. I didn't mean to go down that path, but in a world where labor is marginalized, that just puts a bigger onus on the government. So this year, the government, in what has been a very strong economy, we're still running 6 to 7% deficits in the United States. So that's about $1.5 trillion deficit with a T, trillion. All of that is being expected to be funded by the public. So that's domestic savers, domestic corporates, foreign buyers. But if we are going to structurally run 7% deficits, which the Congressional Budget Office is, which is a U.S. government budget agency, they say we're running 7% deficits for a decade. So we're going to add over 20 trillion to the U.S. debt. And if our weighted average cost of debt is 3.5%, that's $700 billion of added interest right there alone. So to your point, if you can't grow your way out of these debts, which would require something like a post-World War II miracle in labor, productivity, economic growth, I don't think it's even worth entertaining. You basically need to debase the debt. And so when you look at the end game, inflation is the friend of the Fed. No one will say that out loud. Nobody will admit it. You kind of have to posture and say, hey, we're almost there, mission accomplished. But at the end of the day, sub 2% inflation is much worse for the United States and debt earnings greater than 3% inflation. Hard stop.
Yeah, indeed, and it's a little frightening when you think about the percentage of the total debt that's due to roll over in the next 24 months, and the debt that it was set at much lower levels, and now as it's going to be rolled over, presumably at rates more like 4.5, 5%. Obviously, the interest burden really starts to increase. So unless we are going to get this productivity miracle, it seems like it's all heading one direction. Which leads me to the ETF that you manage, INFL. Talk me through the thesis behind how this has been structured and the particular business models that feature in the ETF that are those inflation beneficiaries.
So we were early, some would say wrong, or it's a fine line. Are you early or wrong? But as early as 2015, we started banging the drum around like, hey, this is unsustainable. Rates are effectively at zero. Government finances are a disaster. If you remember, Europe had all that negative yielding debt. In 2017, what was it? Austria issued a 100-year government bond at like a 2.2% yield. And we said, look, this eventually, that in and of itself is going to cause a problem. But then we look at all the misallocation of capital going on in just unproductive uses. But then on the other side, where the capital wasn't going was where we needed it in resources. So if you look at a supply, an underinvestment on supply, and then a glut of capital flowing into the system by virtue of government spending and low interest rates, like this will not end well. And it looked like it was a slow burning fire and, banging our head against the wall. And then COVID hits and then, the match hits the powder keg and boom. But even long before COVID and long before this product was officially launched, we had an internal managed account strategy, which we called the hard asset capital light model. And so the genesis of this was, okay, let's look back at regimes where there was an uptick in inflation, there was an uptick in interest rates, and there was this orientation in the economy kind of around these resource and raw materials and kind of the old economy. And the problem with that is there's not really a lot of cycles. You can look at the 1970s, but you had two oil shocks. There's a lot of externalities. And then you go back to previous inflation cycles, and you didn't have a globalized economy. You didn't have China involved. You didn't really have Japan engaged. You didn't have Korea. And so there was no analog. And I think that that's really difficult for people in the financial community is like, sure, you can look at other cycles, but no cycle is a perfect analog because things have changed so quickly over the past, 20, 30, 40, 50 years. But one thing we noticed is that you want to own real assets. That was obvious. And so real assets come in three primary varieties: real estate, infrastructure, and resources. The problem with all three is that there's a capital intensity. So real estate, you're building a building; infrastructure, you're building a bridge; resources, you're digging a mine. That costs a lot of money and takes a long time. So one way that there's capital intensity is that you are sinking a lot of money into developing the project itself. Then you also have working capital, which is required to operate the asset. Generally, because it's such a long-term capital intensive project, you're also using debt. So these are three different avenues where you have a capital intensity and a rate sensitivity. So let's look at the first two, real estate and infrastructure. Because we went through such a prolonged period of artificially low interest rates, they became interest rate proxies. So people were paying 2, 3, 4% cap rates, so effective operating yields on infrastructure and real estate. When interest rates go up, that's a problem. On the resource side, you have this capital cycle theory where, sure, you tie up all this money in these mines or these oil wells or agricultural fields, but then these companies just would, every time the cycle was going in their favor, they'd add supply, and crush themselves. So that CapEx side of the resource side just really impaired a lot of capital. So we said, look, you can make a lot of money. There are a lot of great assets at the right price, but you have to time the price, the cycle very well, if not perfectly. How do you control for that? You control for that by trying to find exposure to real assets, but via a capital light business model. So high profit margin, high operating leverage. So revenues can go up without cost participating, limited reinvestment risk. So you can really leverage the long-term asset appreciation, but where it accrues to the shareholder instead of accruing to a bondholder or a management team. And that was really the thesis. And, I think that it might sound counterintuitive, but there's actually a lot of business models out there that apply that, might be kind of hiding just below the surface.
Indeed. So talk me through some of those business models. I know you like to break them into maybe three main silos. What would be a great example of said business model?
I'd say the best example and our first silo, we call it the direct beneficiary, the direct exposure to the assets would be royalties. So in a overly simplified example, a royalty owns a financial interest in the land or in an asset. It could be a mine, it could be an oil well, it could be land, which could be agriculture, real estate development, or it could be intellectual property, things like medical patents or music or film patents. But the idea here is you have a revenue interest in a hard asset and you are participating at the revenue side. So again, just to give you an example, a miner spends $1 billion to develop a copper mine. You have a royalty on the revenue of that copper. You are getting a percentage of the volume of that mine times the price. You're not subject to operating costs. You're not subject to break evens. You're not subject to CapEx. In fact, you get a free rider on CapEx. So because of the nature of the royalty, many of these companies have 90% plus gross margins or operating margins, and they can have fully taxed profit margins at around 70%. So by virtue of that profitability, not only do you have a cushion on the downside. So when oil went negative in the US in 2020, granted it was only for about 5 minutes, but when it was below 20, below 30, virtually every operator in the US is hemorrhaging cash. Royalties are still giving you checks because it's a revenue interest. And all of these wells kept pumping because it's more expensive to shut them down rather than just to ride through kind of the storm. So you're cushioned on the bottom. So you're living to fight another day. And that base is established. So then you can compound on the upside. So then when oil snaps back and ultimately recovers to over $100 a barrel during the invasion of Ukraine, now you have a flat cost structure. So your costs don't change, but oil goes from 30 to 100, and that's all leveraged to your bottom line. That is really a simplified example of what we want to leverage in all of the businesses is get that optionality on the volume and price so that can accrue to shareholders. And again, royalties are the best example. They exist in base metals, in energy, in pharmaceuticals, in music, in agriculture. There's even some in renewables and, a large and growing pool of these are in public markets, and there's an even larger bifurcated private market. But that was really the inspiration for the fund. And we took that and then applied it to other businesses that are applicable that aren't direct royalties, but might be in these kind of other verticals that you mentioned.
Absolutely. So let's talk about those. Let's talk about silo number two in other types of businesses that can benefit from increased volatility, increased revenues without commensurate increases in the expense column.
Sure. So the second category would be indirect. So in the first, you have a direct pecuniary interest in the asset. And one thing that I should have mentioned is that with a royalty, you have the senior claim on the asset. So oil and gas operator X is operating on lease Y, and let's say they go bankrupt and they have to basically sell off all of their assets. Your royalty supersedes that process. Your interest is at the asset level. And I think that's really important, especially when you think about duration and longevity. And, we're playing for the long term here. But then when you look at the next category, indirect, you benefit from the asset prices and you benefit from the volume, but you don't have that direct exposure to the asset itself. So a great example would be financial exchanges. So think about something like the London Stock Exchange, the ASX, the Intercontinental Exchange. The largest and most profitable markets in the world today are derivatives, primarily in interest rates, currencies, commodities, and index futures. All of these obviously are very sensitive to inflation, prices, economic growth, and volume. But these businesses today are basically computers. So they are applying zero balance sheet, just matching buyers and sellers, transferring risk. And the more volume and the more pricing that you get in these markets, the more revenue flows through the exchange. But as I mentioned before, because it's basically just a computer, their cost structure stays largely flat. And so you might be surprised to learn this, but if you were to look at the S&P 500 on a rolling quarterly basis over the past decade, 4 exchanges are consistently in the top 10 most profitable companies in terms of profit margin every quarter. And that's because of this business model dynamic. But valuation matters, right? So if you look at the valuations of these exchanges, they trade 5 to 7% free cash flow yields, which might not sound like a screaming bargain. But if you look at companies that are in similar business models in data and analytics and credit cards, you're talking 2 and 3% cash flow yields. And so I would argue we have the better business at half the multiple. Another good example, we referred to infrastructure and real estate earlier. Capital intensive, rate sensitive, cyclical. I'm not really sure what the cycle is going to look like. I don't know what rates are going to look like, but I do know that people are going to look for a lot of inflation indexed exposure. So why not own the asset manager? So own something like a general partner investment partnership where they earn fees. So they earn fees on managing the asset and then carried interest. And so that gives you an indirect exposure to that infrastructure, to the renewables, to the property, without having to take that large leveraged direct exposure in those assets themselves. And again, profit margins here could be 40 to 60% on an operating basis, where, obviously once you kind of go through all of your leverage and everything at the property level, you're going to be nowhere near that. And so what we like about this area is it allows us to diversify, so you're not completely captive to your traditional commodity natural resources, where we have indirect beneficiaries and everything from healthcare to industrials to financials to consumer. And it really allows us to be very creative and then kind of think through where we think we are in the inflation and economic cycle, while still owning great businesses that have the same attributes as the primary beneficiaries.
Indeed, and it takes a lot of the pressure off trying to time the cycle or knowing how much inflation will be throughout various points in the cycle. Because if I point viewers towards your commentaries, there are several examples across various different cycles where a commodity price may have gone up, a commodity price may have stayed flat, or even gone down. And in almost every case, the royalty aspect has outperformed in all 3 of those scenarios. I'd like to, before we move on to perhaps some specifics, let's talk about the call option aspect. So we talked about, okay, you've got protection to the downside, you've got a call option on volume and on prices of the underlying asset. What about a hidden call option that a lot of people don't think about, which is the call option on the operator's capex over time, improving the life of mine or life of the resource itself, for which you get to participate in the revenue checks, but you don't get to participate in the capex checks.
Exactly. And I wrote a white paper on royalties that I'm happy to make available to your subscribers if you can post it with the episode. But I go through this example in that white paper. But so one of the most widely recognized royalty companies in the world is a gold streamer royalty company called Franco-Nevada. And one of their first royalties was the Gold Strike mine in Nevada. And this was a small mine, small reserve base. Nobody really knew it was there, small operator. They paid $2 million for basically a perpetual royalty on this mine. And a little bit of luck, a little bit of skill, probably, and a combination of a lot of great factors. American Barrick buys the mine. So you go from a junior operator in kind of a backwater of Nevada mining to one of the biggest miners in the world. They all of a sudden throw a couple $100 million into this mine, and you're sitting there with a royalty with no exposure to their OPEX or their CAPEX. So fast forward to today, and I'm skipping a lot of the major parts, but they've put billions of dollars into that mine. Franco-Nevada on that original $2 million check. Now, some of this has been gold price appreciation. Some of it's been organic production. A lot of it's been the CapEx of Barrick. That $2 million check since 1983 has delivered over $1.2 billion of cash flow. And we think there's another $500 million plus at $2,200 an ounce gold. So, quite literally $2 million could deliver a undiscounted $2 billion over the 40 years subsequent to when they wrote that check. And a big part of that was that they had a free rider on that Barrick mining investment into that mine. And so when you look at the economic returns of the miner themselves, sure, they were great, but they were nowhere near these parabolic economics of the royalty itself. And so what you originally referred to is that call option. And so something we try to do in all of our portfolios, particularly this portfolio, is can we underwrite a 10 to 12% rate of return based on conservative estimates of current production, current volume, current pricing? And then do we have optionality? So could there be more volume? Could there be higher prices? But then are there other CapEx levers that could be pulled where, hey, we've got this project that maybe doesn't make sense today, but in a certain scenario, could this be an extra 40% on the stock? And having as many of those embedded call options in your portfolio as possible is really a phenomenal investment strategy, because if they don't hit, they're free. So you get your 10 or 12 if you underwrite properly, but then if those things hit or a couple of other factors go in your favor, now you're 15, now you're 18, now you're 20.
Indeed, truly phenomenal. Moving slightly in what seems like a different direction, but it makes sense when we talk about the monetary debasement aspect. A lot of people think you guys as a traditional Graham and Dodd type value shop, and so you don't necessarily associate cryptocurrency or Bitcoin with such a firm. How did Bitcoin become an investable asset, at least in the eyes of you guys? And what do you see its role as in a portfolio moving into the future?
Again, I have to give credit to Murray where, I want to say it was 2014 or 2015. Somehow he came across the Satoshi white paper, which was basically the original anonymous programmer who wrote the protocol underpinning Bitcoin. And Murray, this is around the same time that we were getting concerned and frustrated with profligate government spending and interest rates effectively at zero. And he said, look, this is wildly speculative, but it makes sense. And without getting into all the nuances of how the Bitcoin blockchain and mechanism works, it was basically there's two prongs to look at. One is the applications of the blockchain itself, and decentralized ledgers are nothing new, but the encryption process of the block process, we thought definitely had some big application uses. But then I think one of the biggest aspects of the monetary policy is that it's a deflationary. So you have these halvings where the amount of blocks rewarded for the miners goes down in these halving cycles. And then ultimately there is finite issuance. And so when he looked at it both from a monetary standpoint, but also a technological standpoint, he said, look, this makes a lot of sense. And even though it was wildly speculative, I think back then it was 200 or 300 a coin. He said it makes sense to have a tail position here. I could see scenarios where it goes up thousands of times or scenarios where it goes to zero. But again, in a world where fiat currencies, so dollars, euros, yen, pounds, francs, whatever it may be, we're printing more and more of these. And, I think the term printing is misleading. People look at M1, M2, M0, but look at what the government's doing in terms of government deficits. So, obviously that has to get funded and sterilized somewhere. Look at Fed balance sheets, look at the policies that are being run. And I think that we increasingly see the desire for people to have an outlet of the traditional fiat system. And, people in Argentina, they get it immediately. People in sub-Saharan Africa, they get it immediately because they've seen their life savings wiped out in fiat. And again, in these OECD countries in the Western world, yeah, we've seen bouts of inflation, but, we definitely have the privilege of never going through just a crippling devaluation. And we're not saying that's going to happen, but I think that it's a slow bleed and people are starting to say, I want something outside of the system. And as it relates to gold as well, you can see, the dollar's pulled back quite a bit here, largely by virtue of the yen kind of strengthening on the BOJ action. But with the DXY, the dollar index over 101 and the 10-year treasury, just under 4, those are pretty tight conditions. That should be negative for gold and Bitcoin. But here we are this morning, gold's over 2,500, Bitcoin's over 61,000. And so these alternative store of values are dismissing historical relationships between real bond yield and dollars, where I think they're telling you something that traditional finance is missing or not telling you. And I think that that's really important. But that's a long-winded way of saying that, obviously, I think that it's really remarkable for someone who's been around a long time, a Graham and Dodd, quote unquote, gray hair investor, to have the ability to give crypto a fair thought, whereas so many people just dismiss it as snake oil. I did myself. And Murray actually had the open mind to say, let me actually look at this and then give it the appropriate thought. And, he's made a lot of our investors and a lot of employees at our firm incredibly wealthy by virtue of that open-mindedness.
Yeah, indeed. It's a great point. Which would you rather, crypto or long duration bonds? I don't know. I don't know about I don't know about long duration bonds at the moment. Personally, I got a little bit of gold here and there, a little bit of crypto. Speaking of crypto, and speaking of land, and speaking of something really weird that you guys have access to, which is cheap natural gas in its abundance. A lot of activity going on in these types of areas in the Midwest, is my understanding, where you've got crypto miners moving out there to take advantage of the cheap natural gas to power the mining aspects. Are you guys involved in that, or are you kind of indirectly involved through a typical inflation beneficiary style exposure?
Well, we're directly involved and indirectly involved, both through equities and inflation beneficiaries, equities in our other portfolios, and we actually have direct crypto mining. But I'll back up if I may, just for the benefit of your listeners. The United States is very unique. Everyone's heard about the shale revolution and the amount of oil and natural gas that's being produced here, but for the U.S. is endowed with geological abundance of natural gas. So methane, which is dry gas, which is what, we have a ton of it. You guys actually have a ton of it, particularly offshore in Australia, but it's about it's about double as clean or half as energy, carbon intensive as coal. So it's a massively cleaner technology. The problem historically with gas is that gas is large. It's very expansive, and that makes it very difficult to transport beyond the pipeline. We have learned, and with higher gas prices, to condense gas via a freezing technology to basically liquefy it. So if you liquefy a gas, it turns from a gaseous state to liquid. Now you can put it on a vessel and you can send it around the world. So because of that, now you almost have an international gas market. But the problem with the United States is we have so much gas and so much gas production that we are unable to effectively consume it all. And so whenever you see one of these LNG export facilities go offline, then you see a crash in US gas prices because we don't have enough place to store it here. So in most environments, the US, particularly the Permian Basin, where you have all of these shale wells, just doesn't have enough storage and there's too much gas. Even though the world, particularly when there's a cold winter in Europe or a cold winter in Asia, is desperate for this gas. We just don't have the infrastructure. So In some cases, you could have oil at, or excuse me, natural gas at an oil equivalent of $5 a barrel or less in the US, and it could be 100 barrels of dollars in Rotterdam or Japan. So with that in mind, a lot of the gas is trapped in the Permian Basin. And so in the Permian, you've got basically free or extremely inexpensive gas. To the extent that you can use that gas for a gas turbine, that can be used for powering a variety of data centers. So one type of data center is Bitcoin mining, which is a kind of lower tech, simple like compute, or high performance compute, which is kind of these newer data centers that are required for GPUs, both of which are wildly energy intensive. So at Horizon, we have exposure through Consensus Mining, which is a private crypto mining entity which owns these data centers for crypto mining. We also own energy royalty and land companies in the Permian that have royalty exposure to crypto mining, to data centers, and to this cheap gas and power transmission dynamic in the Permian as well.
Yeah, makes an awful lot of sense. We're coming up on the 5 minute mark. If I'm allowed to ask you what one of your highest conviction plays is right now, what would it be, and what's the reasoning behind that particular thought process?
Sure. So, I mean, I don't obviously this stock has done wildly well recently, but I think that it's appropriate given kind of the lead in. But there's a company called Landbridge. It went public, let's see, a couple months ago now. We were one of the leads on the IPO process, and it's basically a land bank in West Texas that's a royalty. So 90% margins on allowing third parties, some of which are affiliated with Landbridge, to transport water, to do power lines, pipelines, frac pits, kind of everything that's associated with traditional oil and gas extraction. And the way that they've grown their acreage, there's a very attractive organic growth profile by simply just replicating their footprint in different areas of the Permian Basin where they've recently acquired land. But I think where it gets even more interesting, so you've got a nice 15-20% compound annual growth rate at 90% margins with zero CapEx by virtue of the business model alone. So again, talk about your call option, your base case. Your base case, pretty darn good. The really interesting call option is that because of what we just spoke about, you've got cheap gas in Texas, you've got an abundance of land, you also have plenty of wind and solar, you also have a massive amount of water that's coming out of the oil and gas formations. So this is almost a perfect situation for these new large language model data centers, because data centers are typically clustered around population centers because you need low latency. You call up Amazon, you call up Facebook, you need it, boom, boom, you need it quick to come back. If they're training a large language model, you don't need to worry about a quick response to your users. So you can put it in the middle of the Permian Basin. So now let's walk through all the components you've got here. So you've got cheap land. Two biggest impediments after land for a data center is power and cooling. So with power, you've got cheap gas, so you can do cheap wind turbine, you can do cheap gas turbines for non-interruptible, non-intermittent power. You can supplement that with wind and solar. So now you've got a green supplement. You also have this abundance of water from fracking, and you can do liquid immersion cooling, which is immensely cheaper and more efficient than forced air cooling. Wrap it all together, you're in Texas, which is ERCOT, which is unregulated power grid. So you can actually do what's called demand response. So you can sell the power you don't use back into the grid, and it's not a regulated grid. So you don't have to deal with the Federal Energy Regulation Commission. So you can actually get these things up and running quickly and efficiently. So all that being said, great, perfect environment for data centers in what is a wildly capacity constrained market due to land, power, water, cooling. Landbridge actually has a letter of intent with a hyperscaler data center to do the first proof of concept data center They have already identified no less than 6 locations. And so, should this come to fruition, obviously that call option would come into the money. If not, we think we've got a pretty great business without it.
Yeah, absolutely. And I think I really like the ability for the company to take a clip of the water pipelines from its affiliate. I think it's called Waterbridge that can
Correct.
move
Yep.
across the state lines. Super interesting play. I'll be very interested to see how it plays out. Is there anything I missed? Is there anything you would like to leave viewers with that I perhaps haven't touched on today?
No, look, I think that we've had a great discussion. We've talked through some high level, some micro, some macro, inflation, and one of the things that I just think is really important again, and not to be redundant, but it's very easy to look in the rear view mirror and say, well, what was the status quo in terms of interest rates, inflation, economic activity, but also market leadership. It's like, you know, tech is the only thing that goes up. Tech's the only thing I want to buy. And, nothing lasts forever. We know that, but then people have this anchoring effect where they have a very difficult ability to comprehend and understand change. And based on our discussion, I think we're going through a really radical, fundamental change in the composition of the world, the economy, and financial markets. And so you need to think very differently about how you want to position for the next 10 years, not necessarily the past 10 years. And I think that we have a pretty eloquent solution and are thinking about things pretty originally. And so, hopefully things can continue to work out well for us. And, obviously a lot of things are going to be happening between now and November and now and the end of the year, but we think we're in a good spot.
Indeed, I tend to agree. People's expectations of the future are set by the experience of the immediate past or something like that. James Davolos, thank you very much for your time, guys. Links to where you can learn more about James, his role at the amazing firm Horizon Kinetics will obviously be in the show notes in the description. Thank you very much for tuning in, and I look forward to catching up with you in another episode of the ROI podcast shortly. Take care, guys.